All right, cool. All right, this is lecture 5, I believe. And this lecture is at this point, we'll move into, so we've completed all the framework stuff. All right. Now we're moving into understanding how to execute. But what you guys will see is that everything that we've covered up until this point, it is literally repackaged into a very, very fractal state. All right. Because what you'll see, even with the entry model, it's using all the same things that we've already spoken about, and it's kind of packaging it into being able to see it even on the smallest scale. So when I mentioned to you guys that everything literally points back to that very first that fractal, this main fractal, as simple as this seems, there's so much that you can pull out in terms of understanding when it comes to the market from this one fractal. All right. And that fractal, right, is basically Model X. All right. So Model X combines the logic of using imbalance to gauge market structural shifts, the change in state of delivery, and institutional order flow. All right. So there are 4 steps to the entry process. All right. The sequencing and the flow of these steps are very significant. All right. So you should never take them out of the standard order of operation. All right. Because everything is it's a very response based step by step type of process. All right. So every movement or every step that occurs is the step that happened before that is very vital. All right. So the 3 steps are as follows, or the 4 steps, I'm sorry. Very first step is the sweep of liquidity. The next step is seeing the imbalance negated. All right. From there, we want to see the order block validated. And then step 4 is institutional order flow confirmed. I did hit record, right? Perfect. All right. So these little abbreviations, EFD, OBV, IOFC, right? That just kind of helps us remember that procedural or that process. All right. So when it comes to us executing, as mentioned, the very first step is that sweep of liquidity. All right. Now, let's say that we're in a market and we'll just draw the easiest scenario here. So let's say we've had this, all right, and we've had this. We all know at this point that's the dealing range, and we're gonna redraw this little scenario, but we're just gonna draw it uh, as if we were zoomed out. So let's go and let's place this fair value gap. Let's say that inefficiency is like resting right here. All right. And we've saw price come back down, right? It's New York. We're thinking OTE. All right. And then we had that low, that short-term low created above that high. All right. So this is the scenario, right? This is the stage. All right. So now we're zoomed in and we're ready to execute or see if price is going to change hands. Because remember, when this market is trading back lower, right? Order flow on that lower time frame is bearish, right? We're seeing those up close candles support price on that lower time frame here, right? And once we get down to the higher time frame array, right, to the more apparent order flow, now we have an opportunity to see if price is going to give us the correct response. And that response will tell us if that array will become the catalyst and turn price around. All right. So the very first step is seeing a sweep of liquidity. Once I see a sweep of liquidity, my attention should immediately go to the stop point leg of price. All right. By saying a stop point leg of price, all it is the actual leg of price that runs out that low. Okay. Now, as I'm looking at that stop point leg of price, I need to locate the candle that houses the imbalance within the stop point leg. All right. That candle is important. Okay. So that little piece there is kind of like the crack code. All right. Because when we're validating the order block, all right, the crack code is understanding that we don't have to, as ICT explains, we don't have to take that full series of candles, all right, and then wait on the change in state above here. Okay, because this is what, this is what ICT basically references as the algorithm will remember that point in price. All right. Well, we've kind of gotten to the point where we realize and understand that we can take the candle that houses the imbalance within the stop point leg, and we can use that candle to validate our order block or initial change in state. All right. So that candle here, this candle is what we call the housing candle. All right. So just for a step-by-step or thinking process, once we get the liquidity sweep, my eyes immediately start looking for the imbalance on the left side of price, right? Most people pay attention to the imbalance on the right side of price, but the more significant inefficiency is that inefficiency on the left side of price. All right. And we call that the housing candle. All right. It's termed the housing candle because it houses the imbalance within the stop point leg. Okay. So that's step 1 and 2. Step 1 is sweep. Step 2 is, actually, step 2 is seeing that imbalance negated. All right. So once we've had the sweep, now we're watching price is delivering. Okay. And we see this first little up close candle. All right. Nothing significant yet. All right. The next thing we see is this up close candle here, trades higher, and we get a body closure. All right. So remember, step 1 is sweep. Step 2 is imbalance negation, right? Which is what we call EFD. The reason we say EFD, because when you have an inefficiency, you say that, that's an inefficiency. So we've just put it together and said, hey, once price closes the inefficiency, we'll just say it's sufficiently delivered. All right. And so that's step 2. So if you look right here, that imbalance stretches right to that point. We've negated that imbalance. So now this idea goes back into when we're learning that whole market efficiency paradigm, and we're learning that price trades from stops to inefficiency, right? That trending market, it's going to trade from stops to inefficiency until met. Lando, are you able to let that guy in?
Yeah.
Okay, cool. All right. So when we're trading stops to inefficiency in that trending market, up until price reaches a higher, much stronger force, right, which would be a higher time frame rate. Now we have an opportunity to see the response, right? And if we're in a reversing market, price will say screw the imbalance, right, and trade to opposing stops, all right, eventually at some point. Okay, so let's erase this. All right, so now we've had the sweep and we've had the imbalance negated. At this point, we're seeing a shift. All right, we're seeing that this higher time frame array, right, is it could possibly hold some weight, right? So once we have that imbalance negated, remember the housing candle is super important. I'm looking at the high of the housing candle. All right. If price trades beyond or breaches the high of the housing candle, right, that is going to be step 3, right? That's going to validate the order block. Okay. So very important point. I don't have to, this is going to kill me if I don't get this line straight. I don't have to see price close over this portion. I just need to see it breach that portion. All right. So even if we had a very small up close candle here, say that candle, maybe it has a wick to the downside and then a wick to the upside. At that point, right, that validates the order block. Okay, I don't have to worry about that candle. All right, at that point, that validates the order block. I'm going to do all of my work off of this, from the starting point of this candle down to the low. All right. So let's go back through the steps. We've had our sweep. We've had the imbalance negated, right? And the order block is now validated, okay, because we use the high of that housing candle. Now that we have the order block, right, and remember, we say that the OB equals the change in the state of delivery, right? But instead of us taking that order block for face value, right? Because now we're going to see this range of price as our OB. Maybe I should have used a different color. We're going to see this as, you know, that order block. Okay. Well, instead of us saying, all right, cool, we have a CSD or a change in state, right? We have a order block. And instead of us just taking a blind entry, right, we add a little more confirmation to it by saying, hey, well, if I'm going to expose my portfolio to the market, if I'm going to be a buyer, I'm only going to be a buyer when I can truthfully say that IPDA has showed me that the institutional order flow is bullish. Well, how does IPDA communicate that to me? If I see a down close candle at this point, down close candle trades back into the order block, all right? Now think about it. This is my OB, right? We validated here. Now we're delivering back inside of the OB. And basically what I'm saying is, hey, IPDA, prove to me that this order block is going to force a second change in the state of delivery. If so, at that moment, I can truthfully say or technically say that down close candles are supporting price. In a market where down close candles are supporting price, that means we're on the buy side of a curve, right? At that moment, it makes sense for me to be long and expose my portfolio to the market, right? Because we're on the buy side of a curve. So when that price comes here, all right, and there's a key point that I have to make about this. When price comes here and it trades above the high of this candle, all right, that is price forcing that second change in state of delivery. All right, now let's talk about something right here. And we'll get into filters and all that stuff, but I do want to just briefly mention this. All right. So what I'm teaching you here is to basically you're going to execute the very moment that price trades above the high of that candle. All right. And what we get when we see this is speed. Right. If you think about ICT's propulsion block, right, a lot of times it's not going to be exactly the same nature of a propulsion block. All right. Or the same image, but the nature of it, because of that second CSD being created, you'll get speed. However, but as soon as price trades above the high of this candle, that's when we execute. All right. And you should see that market 90% of the time when we're right, we get immediate feedback. All right. But the point that I want to make is when we're on the lower time frame, like a 1 minute time frame. All right. Obviously, 1 minute can be slightly, a little tricky sometimes. So when you're on that 1 minute time frame and you're waiting on that next candle to deliver and you're watching price, right? This is a 1 minute and you're watching price. Sometimes, not a lot of times, if you execute as soon as price trades above the high of this candle, right? And let's say there's maybe 15 seconds left in the creation of this 1 minute candle. Sometimes it'll come here and then it'll flip. All right. So you just executed because you saw that as CSD and it flips. Right. And this happens to be like a bearish candle, or maybe later on it trades back above, or maybe it makes another low. All right. So how do we kind of offset that? If you're on that 1 minute chart, right, you may risk some R a little bit, but allow the 1 minute to actually close above that candle. Okay. And that doesn't mean that it will never ever work, because we've done it 1,000 times where we instantly take that entry the moment it trades above this candle, right? But on the 1 minute chart, just be mindful. You probably want to allow it to close, and there's a great feeling that comes with that when you actually see that closure, right? Because that really adds conviction behind you understanding that you're right about that particular trade idea. All right, but we'll get deeper into filters and all that stuff at a later point. But just for being robotic, right? There's 4 steps. We have a sweep. We need to see the imbalance negated, right? Once the imbalance is, we have a sweep. We locate the housing candle, which is the candle that houses the imbalance within the stop hunt leg. Right. That's a key point. A lot of people miss that. It's the imbalance within the stop hunt leg. All right. 3, we want to see the order block validated. What validates the order block? That the candle that houses the imbalance within the stop hunt leg, the housing candle, when that candle's high is traded through, that validates the order block for us. All right. Do we take the order block for face value? No. What do? We allow institutional order flow to confirm itself, right? By seeing a down close candle trade back into the order block. And once price trades back above that down close candle's high, right? 1 minute time frame, we want to see a closure. And once that occurs, we execute immediately. And a lot of times we should get immediate feedback. All right. So let's talk about like stops. Okay. If there's a scenario where you have, let's say you have an inefficiency, right? So we have this imbalance, this buy side imbalance was created here. All right. And obviously this would be a BPR with those two inefficiencies. But let's say you have that buy side imbalance that we just created on this side of price, and you have you execute at this point, right? In this scenario, and there's no one way in terms of stops with this, all right? Because at this point, you guys can all think logically and make sense of where your stop should be. But some of you may be more aggressive, some of you may be more conservative, all right? But in the event that you take this trade, if you have an imbalance here, let's say that imbalance, this is not drawn to scale. Let's say that imbalance has never been tapped. All right, you probably really want to come and place that stop down here, right? And you can place it safely below this candle because technically we shouldn't run back below this candle, all right, to begin with, all right, because the imbalance is here. So if we trade through that imbalance, then that probably means we're wrong about that trade, all right. So in that scenario, you want to place the stops here. Now, if there was a scenario where price had already, you had this, we've already tapped that imbalance. It doesn't have to fill the imbalance or anything like that. It's just that price engages with the imbalance, right? Then when you do your own back test, you'll see that you'll be able to place that stop literally right here, all right? But that's gonna depend on you guys' risk acceptance or risk tolerance, okay? Another scenario that could arise is, let's say that you take this this trade, all right, and the market gives you a slight push. All right, so it gives you a slight push, and I'm going to ask a question. I want you guys to answer it in the chat. So it gives you a slight push, and then it trades back lower down to here, right? Running out this low, and then we see it trade back higher. Boom. All right. So let's say you took that entry, erase this. You took the initial entry from here, right? And you had your stop loss. Let's say you had your stop loss here. All right. Now obviously you just got taken out. I want you guys to answer in the chat. Does that invalidate the trade idea? Because you just got taken out of the trade, but does that invalidate the entire trade idea? Okay. Perfect. Perfect. Good job. Perfect. Cool. You guys are sharp. Perfect. Right. That does not invalidate the trade idea, right? That could just be an inducement or just, time distortion, prices just hanging around just a couple more minutes. All right. But it does not invalidate the trade idea, because the trade idea is based on the premise that we have an order block, which is the initial change in stated delivery. So if that happens and let's say you get stopped out, right? -1R, okay? Then as someone said in the chat, you can literally just wait for that next change in state, all right? Because the order block still exists. Order block was never taken, all right? That OB still exists. right? You execute here. Now, guess what? We learned in week 1, this is a high resistance signature. All right. So now when you take this trade, it's honestly going to feel a lot better because you have a tighter stop. All right. And this is a high resistance signature. All right. And worst case scenario, if price comes here, then you automatically know that I'm just freaking wrong about this whole trade idea. Just let me step away. All right. But if you get speed after that, you at this point you've already made back 1R. All right, that little 1R that you lost, and then so on and so forth. Okay. So let's take that. You guys I've already placed these examples in the chat, but we'll go back through them. Because this is a shorter lecture, you guys can feel free to kind of ask questions as I'm going through this, because this is super direct. And then I'll allow you guys the opportunity also to, we can go to any random pair, any turning point in price, right? And we can look for this same phenomenon, because I'm like 1000% sure that it's going to show up every single time. All right. So right here, this is a sweep, right? So obviously, maybe price is trading down. There might have been a higher time frame array down here. Maybe the whole thing is an array. Who knows? But biggest point is we create that short-term low, right? So now we're seeing things from week 1 start to come back into play. All right. So we engineer short-term low. All right. We trade back lower. We neutralize that low. Okay. So now we have a stop punt, right? I need to locate the imbalance within the stop punt leg, right? Which is within this candle. All right. So that candle houses the imbalance. If I didn't have that understanding, guess what I would do? I would take this whole series of candles, right? From that to down to here, and I'd be waiting for price to do that. Right. Or I'd be waiting for a structural shift. All right. Way too late. The move has already happened. Okay. So this is the housing candle. All right. We've gotten the sweep. Now I need to see that imbalance negated. All right. So literally right here, price trades higher, negates that imbalance. That is EFD, right? Efficiently delivered. The next thing that I want to see is the high of the housing candle breached. That validates the order block, OBV. All right. Now I'm saying, hey, IPDA, if you are bullish, I want you to prove to me that you're bullish by trading back into the range of the order block and forcing a new change in the state of delivery. All right. So literally this down close candle trades back into the OB. And right here is when we get that second CSD. We execute at that very moment. We can place stops here, right? We've engaged with the inefficiency. And what do we get? Speed. All right. A great comparison to this of why this is so vital is if you look right here, right? So we had a sweep. If you look right here, we have steps 1, steps 2, and steps 3. All right. But what we don't have is the final piece. So this would be the stop punt leg, right? We have that. This would be the imbalance being negated, right? Housing candles high traded through. But guess what? Price never retests the OB and force a new change of state. So we stay out. Okay, let's go to the next image. All right, same idea here. I believe these two lines are symbolizing the array. However, we come lower, we create a short-term low, all right, and then we take out that low, right? That's my liquidity sweep. That's step 1. All right. Once I have that sweep, I need to locate the housing candle. Bingo. All right. We have the housing candle right here. And I'm saying, all right, I want to see that housing candle. I want to see the imbalance negated. All right. So literally right here, this candle here trades and closes the imbalance. All right. So that would be EFD. Now I want to see the high of the housing candle traded through. Literally right here, because that validates the order block. All right. Once the order block is validated, right? Notice I don't need a closure for that part. All I need is for price to breach it. The only thing I need a closure for initially is the imbalance. All right. So now that we've gotten steps 1, steps 2, steps 3, last step is we have to confirm institutional order flow by seeing a down close candle trade into the range of the OB, right? And we're going to come back to this because there's something I want to speak about with this in terms of order pairing. But we come back down inside, and then right here at that very moment, right, you take that trade, you execute, and then you get speed, right? Rarely ever, when we're right, when we're truly right, will price hang around. All right. We almost get immediate feedback. Another example here, we have our sweep. Understand, guys, these are all on like 1-2 minute time frame. All right. We get sweep here. We locate the imbalance within the stop point leg. It's within this candle. This is our housing candle, right? Once again, if I didn't have that understanding, right, and I just simply went by the understanding that ICT gives us publicly, then I'd wait on the low of that candle before I'd ever make a decision. All right. So focusing on the housing candle shaded in purple here, the opposing imbalance is negated. The low of the candle was traded through, validates the order block, right? And then now we have up close candle trading back into the OB. All right. You can see that the imbalance has been engaged with. So then literally right here, the moment price trades through the low of that up close candle, I execute. Stops can go here. Speed. Another example here. Excuse me. All right, same idea. Sweep. Right. Once we get the sweep, I'm locating the imbalance within the stop point leg. It just happens to be within the last candle. All right. I want to see a body closure right here. High of the candle traded through, validates the order block. And then these two down close candles trade back into the OB. And the moment we trade above here, IOFC confirmed. All right. This might have been 1 minute time frame, which is why we're right here at the actual candle closure. All right. But still a pretty tight stop. And then we get a little bit of speed. Price hangs around, right? But it doesn't go too far beyond entry. You'll rarely be in drawdown. We don't really get into drawdown because when we're right, once again, it literally goes immediately into profit. But you will have scenarios like this, which this is fine, right? Because entry is here. So, I mean, that's not too bad. But at some point, the market picks up some volatility and it expands. Another example, this is super repetitive. All right. This area is the array or the liquidity pool. However, we get this down here. Another comparison up above, I want you to pay attention to this area right here. And let's see if we have those 3 steps. So we get a sweep. All right. We locate the housing candle. Here's that. We trade above the housing candle. We close in the imbalance. We trade above the housing candle. We validate the order block. But what are we missing right here? Can you guys answer in the chat? What's the last piece? Why would we not execute right there? Exactly. Perfect. Perfect. Cool. So we don't execute because we're saying, hey, IPDA, prove to me that order flow is bullish. IPDA can't prove it, right? We leave it alone. Now we trade down here. Now we see a different story. Here's the housing candle. We close the housing candle right here. We validate the order block here. We trade back down into the order block. All right, now here's another key point. You should really pay attention to this. All right, so you see how we're trading down into the OB right here with this first candle. All right. Now this will literally be kind of our trigger candle, right? That we'd execute on if it trades above that high. However, a new delivery starts at this point. right here. There's an up close candle and then a new delivery starts. So then we also have a high resistance signature. So I can take my entry from this point. Right now, that's, it doesn't really matter. It's probably a half of a pip later, right? If you felt safer here, it doesn't matter. Don't be a robot. Just make it make sense for you and your account. But then this stop should also be pulled up, but this is just for the sake of the image. And then you get speed. All right. So there is no deviating. There's no this time I did this or this time I executed in that manner. No, it's literally the same thing every single time. Like whenever price turns around, there's a 95% chance that you're going to get this pricing sequence. This is that high probability pricing sequence. If you've been looking at these, you should be seeing dealing ranges on a very, very fractal level. All right. Like I can look at this. I'm just taking this first candle. We can stretch that out. That's one, that's two, that's three, right? Four should always take out two. Four taking out two is IOFC. So everything you learn in lecture 1, 2, 3, 4, right, is literally showing up right here on a very fractal scale. All right. So we have this image here. Liquidity is resembled by this black line. We run that low out. This would be the housing candle, right? So housing candle houses the imbalance within the stop point leg. We trade back above. This candle here closes the imbalance. That's literally step 2, right? Imbalance negated, EFD. All right. Step 3, seeing the high of the housing candle traded through. That validates the order block. All right. And then step 4 is just seeing a down close candle trading to the order block. And then once the high of that candle is breached, right, you can wait on a closure, or you can be aggressive and trade at the very instance that it trades above that high. That is IOFC. All right. And then what do you get? Speed, right? Price doesn't play around. Okay. All right. So those are the examples that you guys received a few weeks ago without explanation. Let's talk about this right here is not a deal breaker, but it is for your awareness. All right. Let's talk about order pairing. All right, so if the X's interpretation of order pairing, right, piggybacks off of the definition of fair value, fair valuation, right? We were learning that when price, when there's speed, price trades aggressively through that low, right? We view the imbalance that is left behind, right? We view that as fair value. All right. So what that means is that within that area, we should see order pairing take place, right? Because remember, when we see fair value, the market is going to want to trade back and offer fair value to certain, quote unquote, certain market participants. All right. So if we look at this low here, let me zoom in. If we look at this low, all right, then let's say maybe there's a candle, a straw candle here, a down close candle here, right? That candle wicks below the low. All right. But this candle actually closes below the low. All right. So order pairing should take place within the range of this candle, right? So if price was truly wanting to seek more sell side delivery, it should come back within the range of this candle, right, to fair value and then trade lower. Okay. However, it becomes significant if price trades back above, right, closes and EFD, OBV, all that stuff. It becomes super significant. That candle becomes super significant. Why? Because this is the candle that absorbs the sell side liquidity below that low. So the algorithm or the look back function is going to remember the range of this particular candle. All right. And a lot of times what you'll see is it'll literally, like, even if there's two more down close candles here, the algorithm, the range of this candle would be significant. All right. You can go back test that. It's not a deal breaker to the entry model or anything of that sort. I'm just bringing awareness to you guys in terms of, algorithmic principle. All right. So if you look at this image here, liquidity rests below these lows, but it's this candle that actually takes out those stops, closes below the lows. All right. You can see once we trade above that candle's high, all right. Once we trade above that candle's high, right, price comes down back inside of the range of that candle. It's not concerned about anything else but the range of this candle. But for us, we're not at this point, we're not even concerned anymore, right? For us, we'd be looking inside at this delivery right here. Because I'm sure if this is what time frame is this? Maybe this is 1 minute. All right, this is 1 minute. So unless you go into 30-second chart. But imagine this was a 5-minute chart and you were seeing this and you saw this delivery trading above the high of that, you'd probably be on the 1 minute chart looking for some type of delivery to confirm or to go bullish on, because you understand what has just happened right here. All right. That may be a little more advanced or harder to grasp for everyone at this point, but I promise you it will make complete sense at some point. All right. Same idea here, right? We can look at this candle. It's this candle that actually closes above the high, right? We have another candle up here. However, this range of that candle, all right, because typically we see that as fair value, right? And we would think that order pairing would occur within that candle to turn back around, all right? But then we trade and we close below CSD, and then so price remembers the range of that candle. It just becomes a very strong area, all right? Let's go through a few examples from last week. Or actually, we'll do this. I want to bring you guys to this. All right. So managing stops, right? Money management, because nothing is perfect. No system is perfect. There's never going to be a time where you just wake up one day and feel like, Superman on the chart, right? That moment never occurs. All right. The only thing that occurs is you start realizing that at the end of the day, no matter what system you're trading, rather it's support and resistance or um, supply and demand, right? It all comes down to money management and having an entry and exit plan and doing that objectively without any emotional discretion. So managing stocks, money management. Due to the nature of our entry model, when we are right, the market tends to give us immediate feedback, all right, at our point of execution. We should get speed. So what do we do with this information? Every successful portfolio manager has an objective entry and exit plan. All right. When the trader executes and price hangs around and even pushes back into drawdown, which we're rarely in drawdown, the trader can measure the midway point between entry to stop. If price trades back beyond the halfway point, the trader should exit 50% of volume. What happens is you lose 0.25 R. All right. But you're only exposed at 50% of the initial volume. Okay. So now what this does is it allows the trader to cut losses short, right? That cliche phrase, which is super important, and control his or her downside objectively and without emotional discretion. Okay. So this is something that you won't see in one trade. You won't see it in two trades. What you'll see in is over the quarter, right? Every 4 losses, you're placing 0.25 back into your portfolio. You don't know it. I mean, well, you should know it, but you're not going to see it, right? But where those four losses would have, that would have been an additional R loss, you're actually placing that R back into your portfolio. All right. So you think about 50 trades, right? Or if you took 50 trades and let's say you won 25, you had a 50% win rate. Okay. Well, that out of those 25 trades, I'm not going to do the math here, but you guys get the point, right? That 0.25 for every loss within those 25 trades, it's placed back into your portfolio, right? Allowing the equity curve, right, to survive over time, right? Because you're not going to be right every single time, Okay. But what we do understand is the nature of our entry model. When we are right, we get immediate feedback. So in those few cases where price hangs around, it comes back, you know, down 50% of entry to stop, I'm just going to shut down 50% of the volume. All right. Why? Because I know somewhere down the line, I'm going to catch a trade that's going to immediately go in my favor. Right. So I'm willing to sacrifice this, that 50%, not the full volume, because you don't want to execute and then just close the trade because you didn't want to sit and draw down. However, we're managing this trade. We're being portfolio managers at this point. Okay. And we're basically we're weighing the odds and weighing probability. All right. So you shut that 50% down, lose 0.25 R. What happens is two scenarios. Either you're wrong, all right, and you end up losing. So you initially put up 1 R. However, by way of managing the stop, managing the position, you never lose the 1 R. What you lose is 0.75 R. Remember, you're putting that 0.25 R back into your portfolio. All right. Just the cost of doing business. All right. So the other scenario that could play out is price comes here, right? It liquidates this low, and you get that next change in state. Guess what? You can put don't put the 50% back on, all right? Because if you lose, now you're losing more than 1 R. Just put the 25, put 0.25 R back onto the trade. You don't have to, you could just leave the 50%. Put 0.25 back onto the trade, right? And guess what? The stop that you had here, because this is a high resistance signature, right? You adjust stop and you adjust volume accordingly, right? Because now that stop should come here. Because what we're saying is, hey, there is no freaking way that price should come back below that low again. If it does, we are shutting this whole thing down. All right. It's just too much playing around at that point. Okay. Yeah, so that's that. Not a lot, not a whole lot to speak about in terms of that. We'll look at you guys can feel free. It's an open floor at this point. You guys can feel free to chime in. If there's any random pair that you want to go to and see if we find this same phenomenon anywhere else, then let's do it. In the meantime, while you guys are waiting to speak up, I'll go through a few opportunities from last week. All right. And when I say opportunity, I'm just going through the pricing sequence. It doesn't mean that I would have taken that actual trade based on the framework. All right. But whenever price turns around, you're going to see the same phenomenon. All right. So right here, we have price trading lower. I believe this day we had SMT. All right. But we trade lower. We create a short-term low. Right. There's a stop point. What do we locate? We locate the imbalance within the stop point lid. All right. Right here, price closes the imbalance, and so we get EFD and OBV literally in the same candle. Fine, it's all cool. All right, now we want to see price trade back down into that candle. So right here, this candle trades back down into the order block, right? And then literally right here, rather you waited on the closure or the immediate, CSD, you'd enter, say execute here. We've already engaged with the inefficiency. So stops are safe, here, or you can come here. And right away we get speed. All right. Price doesn't hang around. There's no playing around, right? You get immediate speed, right? Immediate feedback. All right. That's 6R. Okay. Same idea here. Even though this, comes back, this is in terms of time, we wouldn't necessarily engage with this. However, this shows you that this is true algorithmic principle. All right. We have a sweep, EFD, order block is validated. Now we don't come all the way back down into here, right? And for the sake of an image, there are times where you may have to go into, right here, we may go to a 1 minute time frame and you can see, right, the delivery. All right. So don't be a robot. All right. If I'm looking at this 2 minute time frame and I see this, right, I am understanding that this wick means that there's delivery here and then here. So on that side, there's down close candles. So let me just go to a 1 minute time frame and make the image make sense to myself. All right. So key point right here. If there's a scenario where we have so these are the imbalances within the stop point leg, because some of you are probably thinking, well, what if there's two imbalances within the stop point leg? Fine. Guess what? You just see it as one whole candle. All right. Another question that always arises is, well, what if price never comes back to the housing candles, right? What if it trades through the full range of candles? That's fine, right? At that point, we just go with the traditional understanding, which is this series of candles is my OB, right? So if we clear or breach the series of candles, then now we're going to go OBV from here, right? We've gotten our EFD down here, and all we want to see is price retest the OB right here. And then the moment we trade above that is our IOFC. All right. And we should see some degree of, speed after that. All right, let's go to pound USD. Pound USD, we had for the New York session, we call this stage 2, all right, which is that swing to reversal. And let's go here and see if the entry model forms. I think this might have lacked an inefficiency, maybe. But once you get very comfortable with this, you'll understand when to kind of bend rules. It's because common sense should override all rules. Well, not override all rules, but there are times where you understand when to bend and when not to bend. But we do get exactly what we want here. We had somebody in the elite channel that actually took this trade. I posted it on Instagram. But so basically he's looking at this. We can play it out. So if I'm watching this and I'm already understanding, all right, we're looking at price and we've had the Asia low was not taken. All right, and we're rallying up into a premium array, which is the weekly fair value gap. All right, and this is occurring around the 7 o'clock hour. Okay, so the New York Open kill zone starts right here at 7 a.m. All right, so we'd anticipate that this high is going to get run. So even if an entry model forms here, I'm not taking it because of time, right? Time and price have to intersect. All right, so now we get into the kill zone, and we're looking for reason to enter. All right, so we had a stop point here, right? We didn't get any of the we didn't get anything, right? We didn't get the imbalance closed or OBV or any of that stuff. All right, so we're still watching. All right, so now we just breached this high. And once we breach that high, that process starts over. I'm looking for the imbalance within the stop point leg. So if I look here, I can see an imbalance here, right? And then we can also see the imbalance here, all right? So what I'm saying as a trader is, hey, I want to see price close below those imbalances, right? So we close here, we trade below the low of that candle. We can mark the low of that candle off, right? However, if we happen to go below the low of the next candle and close, then we'll be able to use that also. All right. So basically what I'm saying is I'm seeing from that low up here, I'm seeing that as one full order block, one full range. All right. So now I've gotten EFD, I've gotten OBV. Now I just need to see price trade back into the range, right? So we come back into the range of this candle, right? You can see it right here. And once we trade back up, at this very moment, this is a beautiful image, right? You guys are gonna love this image right here. I would literally print this out, sit it in front of my desk, and just watch that image every single day. All right. So at this point, we're looking at the low of this candle. And when price breaches the low of that candle, we execute. All right. We've engaged with the fair value gap. You can be aggressive, if you need to be. If you don't care about super tight stops, I'm not a guy that really cares about super tight stops. This is still tight five pips. Or you can come here, but I'm not that extreme. Like I don't need a 2-pip stop loss. Not that serious. Yeah, and then so understanding the profiles, understanding that New York is open at a higher time frame array, right? Here we go. right? So we hang around just a little bit. We leave and then we come back, right? But this is fine, right? We never even come truly above the high of that ILFC candle. And then we see speed. Any questions about that particular entry? Let's go to EU. So I took EU shorts on Monday. This was the trade that actually came back against me. It hit me break even. But I did execute again. It was late in the day, but I could not resist. So right here, actually, let me go through the framework first. All right, so if I'm looking at this trade, obviously we run above the previous week's high. This high is from Friday. Now I don't necessarily like the profile. All right, I only traded euro last week. I don't like the profile, um, because I don't like. Rarely am I gonna like if there's no distribution between that 3 and 5 o'clock hour, then I'm most of the times I'm not. 90% of the times I'm not. I'm just not engaged. All right, because this is not ideal. All right. However, there was SMT with GU. All right. So SMT with GU followed by a displacement here, right? It's Monday. Then, I'm willing to take this OTE scenario. All right. We have a mitigation block. It's a mitigation block because of the failure swing. All right. We've taken out a previous week's high. Okay. So I'm just putting the pieces together. And then here's an inefficiency. Okay. So price is trading back up into that inefficiency. And I'm believing that, hey, we have a 4 hour down here was a 4 hour fair value gap. We had a volume imbalance where price needed to deliver buy and sell side. So now I am prepped and ready to take a short entry once we reach inside of that inefficiency. This is the trade that I actually recorded live for you guys. All right. So price pushes here, right? Right here, we close the imbalance, but we never get the order block validated. So we're not even concerned. Trades a little higher, engineers equal highs, and then neutralizes those highs. The moment we get that green candle, I'm locating the imbalance, right? And that candle becomes a candle that I'm going to work off of, right? So we have the imbalance negated, right? And then right here, okay, right here, the order block is validated. And this is where we can't get antsy. We can't rush into the trade. We can't say, oh, that's a huge candle. It's never going to come back. Just trust the system, right? It works. Right here, we're coming back and retesting the order block. And I can't execute until it trades back below the low of this candle. Okay. I can either execute at the moment it breaches the candle, or if I feel more comfortable executing at the closure, right, that is going to depend on the individual trader. All right. Everything up here is efficient. Okay. There are no inefficiencies or anything like that. So I can place my stop above that high. And on this day, I was attacking, I was mentioning in the chat 07220. All right. We never made it to 07220. We turn around, break even. We run this high, right? At the point of running this high, the only reason that I executed again was because we had SMT with GU, right? You can see it right here. There's SMT, all right? And go down to, right? All right, and then you can, you guys should see the entry model at this point. All right, run out stops, EFD, right? We close below the imbalance. We validate the order block, and now we see price trade back into that up close candle. And this is our change in state, right? Execution. Execution here, and then trying to get back to 07220. I did not hold to 07220. When price slowed down, it was very late in the day at that point. I just exited the entire trade. And actually, that's not it. Let me see. All right. So if you would have taken this scenario right here, right? then if you place stop above the high of that candle, you're wrong. If you place stop above the high of this candle, right, then you stay inside of the trade. This is a scenario where you'd collapse 50%. All right, but let's go here. I believe it was from the failure swing portion. All right, so looking at a 3-minute chart, it's honestly the same idea. But if you would have taken it from this candle, right, we're coming back up inside, and we'd execute and enter here, right, because this is an up close candle that's retesting it, coming back down, closing below, right, entry, and then you'd want to attack 07220. But as mentioned, once we slow down, I believe it was right inside of this point, or maybe inside of here. I collapsed the trade, and as soon as I collapsed the trade, like the shit just runs. But I didn't want to hold until 3 p.m. At blind market close. I think we had a scenario on GU. This is what we reference as stage 1 for GU. All right, this is that basic OTE scenario. All right, I've been mentioning to you guys in terms of anticipatory skills when trading the New York session, right? If you wake up on a day where Asia high has been swept, Asia low has been swept, right away, if you're the New York trader, right away, you know, hey, this is a highly probable day for a classic sell day or a classic buy day. All right, so if we look at GU right here, Asia high and low, we sweep the high, we sweep the low, right away, anticipatory skills kick in. Now I'm studying this range from high to low. All right. Okay. So what I'm going to do is I'm going to go through my PD array matrix. I have order block, fair value gap, right? Fair value gap here. Also, we got breaker block, and then we can keep it simple and just say, hey, this dealing range, right? 1, 2, right? We're expecting phase 3, and then we're here. Okay. Down to a lower time frame for entry purposes. So we spoke about this yesterday on the Elite Channel community call. All right, so right here, there is no imbalance within the stop point leg. This is a great point. All right, there's no imbalance within the stop point leg. What can we do if there is no imbalance within the stop point leg? There's a few different answers to this. All right, but for the sake of you guys just being introduced to Model X or the entry model, if there are no imbalance within the stop point leg, if you watch that free mini series where we spoke about price reclaiming that, that OB that existed before the stop hunt. All right. So if you run into a scenario like this where you can't locate an imbalance, all right, and once you get it advanced, it won't be a deal breaker that there's no imbalance, because you'll understand that, hey, this shit is really about order flow. All right, just to keep it real. But anyways, we run above this high, and then we trade back below the opening price. Right. So we go back below the opening price of this particular candle. All right. So what I can do right here is once we go back below the opening price of that candle, now I can look to see if this candle, the range of this candle, right, if price holds up, okay, and you can't control wicks, right? Wicks are dependent on different broker fees, right? It's more about the volume. However, if I'm looking at this right here with prompt and entry. All right. Now, I don't take that secondary entry model. Everything that I do is more so based from the framework of Model X. However, just to give you logic, right? You can take this approach, right? Because what you're saying is, all right, cool. If this candle, the price had a change in state from that candle, and we ran the high of that candle, and then we come back below immediate rebalance, we come back below inside of the range, or immediately trade back inside of the range, and we get below the low of this candle, you have to pretend that none of this stuff exists. All right, so it's CSD below that candle. We trade back inside, back below, right? That's the second CSD. You can execute, right? You place stops up here. Let's go to EU. There's OTE shorts. It was like perfect scenario from like 2 weeks ago. There's buys on that day. I think it was a Friday. Yeah, this Friday. All right. So I know there's no liquidity pool to the left here, which is what we want to see. There's at least not an obvious liquidity pool, but we have to honor the fact that this is a high. All right. So we're running that high out. We liquidate that high. This is the imbalance within the stop point leg, EFD. Order block is validated. All right. And we're trading back. We're trading back up to the OB. And right in here, right at that point, we breach the low of that candle, right? And at that moment, we see speed, right? And price should attack that overall low. Another textbook, OTE day, was back in October, I believe. Yeah, this day right here. All right, so Asia low and high have been swept right away. We understand that it's potential highly probable OTE day. I actually took longs in London session on this day. But anyways, New York session comes back, OTE, right? We're trading down into fair value gap. We could view this as a dealing range. We could view that as a breaker, right? And then we're down in a lower time frame and we're wanting to execute. .3 minute, still the best image. 3 or 5 minute, I believe. 5. All right. So 5 minute chart. And this is the more textbook scenario where price actually engineers that short-term low. All right. So we engineer the short-term low. We trade down into the array, right? This candle here is the imbalance within the stop point leg. EFD, right? Order block validated. And notice that price remembers that point, right? It's not random that price is trading back down into the range of that candle. Right? Super algorithmic. And the moment we breach that high, right? This is a 5 minute chart. So when we breach that high, right, it's pretty safe to go ahead and execute. And then the stops would be, right inside of here. Right. We shouldn't really see price trade back down to that point. And it's about 4R, right? Or if you take it at the high, maybe 3R. Right. So in terms of examples, I'll stop there and I'll let you guys kind of guide the rest of the session with questions. Maybe there's opportunities that you saw that you want to see if this shows up. You guys can, ask away at this point.
I just want to ask about propulsion block. You mentioned that earlier. I'm not sure what a propulsion block is. Just wants to know the difference between that and the CSD.
Yeah. So the propulsion block is just like, let's say you have a down close candle here, right? And you have up close candle, right? We have order block. It's just a down close candle immediately. It's kind of like order block after order block, right? So you had down close candle. We trade above the high of that candle, right? And then immediately we have another down close candle trading back into the initial down close candle, and price trades above that high as well. It's like very strong order flow, right? And then what we expect is speed. Does that make sense?
Yeah, perfect. Thank you.
Cool, cool. All right. So like this right here, you would consider this propulsion. Right. You see that? So OB trading back into it. OB. It's just like order flow. It's like strong order flow. Same idea here with this scenario.
If we talk about a scale in trade, can we use this propulsion block as a scale in trade in case in the event that we miss like the first CSD entry?
You can, but I'm not, it's not something that I do. So I'm not gonna give you a straightforward answer, because that's not, it's not something that I per se do. Is it something that you can back test and in theory find logic, right, and potentially apply to your own personal trading plan? Yes, I highly believe so.
Do you have a different method of scaling in, or there isn't any method, or there isn't any scaling at all in this method?
No. There is a method to scale in, but what you have to understand is when you're scaling in into a position, or we're talking about the idea of scaling in, when you're trading on an intraday chart and you're trading, you know, these intraday 20, 30 pip moves, right? Scaling in on something like that becomes, you kind of put yourself into a different environment, right? Because if it'd be different if we were speaking about uh a one shot, one kill model where you're waiting on the high of the week, right? Tuesday or Wednesday high of week, right? You got that first entry, and then there's room to work. Now you can scale in an OTE position, right, on a Wednesday, and then maybe you come back Thursday. Thursday is running into the breaker for Monday. You can scale in again because we haven't reached the target yet. But when you're working with an intraday chart like this, I'm not a heavy scale in guy. Um, because you're gonna run into, you don't know how many times price is gonna pull back. You may see 3-minute propulsion blocks, right? But by the time price reaches here, that might have created a 15-minute fair value gap. So you just scaled in based on those 3-minute propulsion blocks here, right? But what you're not realizing is after 5 3-minute candles, it's created a 15-minute fair value gap. So now price is coming back up here, and you've just gotten taken out, right? And you don't want to get into a scenario where, or now you're trying to rescale back in and all that, right? It's just, I tend to play with the initial volume that I place on the trade to start with.
Thank you.
Mm-hmm.
Hey Chris,
Mm-hmm.
are we okay if we look at Nasdaq future?
Yes,
Because
sir.
I would like to look at the Friday move last week. It was
Okay.
the biggest move of the week, and I couldn't get any entry with Model X. Can we at least have a look at it?
Yes, sir. You said that was Friday?
Yeah, Friday.
Okay. What AM session? PM
Yeah,
session?
AM session.
Okay. And then where exactly, what time frame should I be on, and what exactly are we?
I usually trade on a 1 minute, 5 minutes chart, and I couldn't find any entry with a Model X. Can you please go through if there's any Model X on that day,
Yeah, yeah,
just
yeah.
to confirm?
Okay. So first things first, let's look at the overall framework. All right. So what I can see is here, right? We're trading down into, if we're speaking about order flow, we're trading down into that 4-hour candle. Let's also check the daily chart. Okay, cool. All right, 1-hour chart. So OB here. All right, and then now we can go to intraday. We're taking out this previous day's low. Here, what I would look for here, since this is the previous day's low, I would look for SMT between SPY. Right, so no SMT. Okay. This tool is not there. So from me looking at this, right, because this is like an overextended day, the only potential opportunity would have been inside of here, like at the opening of the bell. You have a little fair value gap right here. And we can go down and see if Model X forms within this little range of price. All right. I can see it on the 3-minute chart. I just want to see if there's a lower time frame. All right. So 3-minute chart. If we're locating the imbalance within the stop point leg, right? So we understand there's a 15-minute inefficiency. Price creates the short-term low, right? And then it runs out that short-term low. Okay, so now immediately I should locate the imbalance within the stop point leg of price, which is right here. Okay, so it's this candle right here that offers the imbalance. So I have to do work off of that particular candle. All right, so once price closes the imbalance, right, we have EFD. We trade above the high of that candle, validates the order block. We trade back into the range of the order block with that down close candle. And the moment we breach that down close candle's high, that confirms institutional order flow. And then I don't even have to say it, right? Speed. So your execution, if you're aggressive, you're trading the moment price breaches the high of that candle. This is a 3-minute chart. You can be a little aggressive when you get to 1 minute, 2 minute. You want to be more conservative and allow the closure. But even if you allow the closure, right, I think that because everything down here is efficiently traded, you can come, inside of here with your stop. And for reasonable targets, I don't know what's above that high. I haven't really looked at this pair. I don't know if there's equal highs that could have been targeted or the top of the range. I think we spoke in the last call about, we called this that low resistance signature, and we were speaking about price potentially getting to previous month's highs. So maybe you do attack that high. All right. But for entry and for execution purposes, that is how you would execute on that particular trade. Does that answer your question?
Yes, yes. Thank you.
Cool. All right. Because that means every step is here, right? We have our imbalance. Price closes the imbalance. Once it closes the imbalance, now we're wanting to see our attention goes to the high of that candle because that's the candle that offers the imbalance. Once we trade through the high, that validates the order block. We trade back down into the order block. In the moment we breach that down close candle's high, that's our execution, right? If we're aggressive, we're going here. If we're conservative, we're allowing the body closure. All
Yeah,
right, and
it's
then
just not
stops will
so
be.
obvious for me.
What was that?
No, I say it was not so obvious for me at that
Yeah,
moment.
yeah. It will be the more practice, more times you visit it and you start thinking, you have that systematic thinking, it'll come up super clear for you. I promise you.
Okay, thank you, bro.
Anybody else that has a pair that they trade, or maybe there's an opportunity they wanted to check out? I'll check the chat. Perfect. Good job, bro. right, come on, guys. You guys got to give me something. I like the questions. All right. All right. I'll take that as you guys are ready to go back test. So if there are no additional questions, we'll end the lecture here. We'll have weekly outlook and things of that sort out tonight. Just looking at the week, or I guess looking at last week, we'll have to just kind of dive into it a little more.
Hey, Chris, somebody's asked a question about Tesla.
Tesla, as in the stock.
Yeah, the stock. Sorry, I know you don't trade. I know you don't trade stocks, but I kind of took a trade on Friday on Tesla based on that framework.
Yeah. No, that's cool. I love it. That's the first, but hey, I love it. All right, what you said Friday, right?
Yes.
All right. And where are you taking entries at? What time?
I took the trade right as it broke above I guess 212. I'm not sure if that was the right idea though.
So 212 is here. So you took longs?
Yeah.
Okay. All right. Let me look at let me kind of look at framework here. We're gonna take a look at this down here to see if we could have taken longs from here, because that it has to be inside of here somewhere. And were you using the logic of Model X for this execution or what?
I was using kind of the logic behind the Model X. I guess I was missing some steps based on this lecture, but I was trading on the higher time frames rather than on the 1 minute.
All right. But maybe like 15-minute or something?
The 15-minute and the hour.
Okay. So all right, if you were looking at it like from this stance, like that's a sweep, EFD, order block validation, and like taking an entry from there. I mean, the fractal stance of entering makes sense. Now I wouldn't enter that on that 15-minute time frame. It just doesn't weigh out in terms of entry to stop. But let's take a look down here in this area and see if we can find Model X inside of that. Okay, perfect. All right, so we're running out stops right here. All right, run out stops, so that's just sweep. EFD, right? The imbalance is negated. The order block is validated, right? So the order block doesn't become validated until, well, actually it's on this candle, all right? So EFD, right? Order block validation, and then we have price trading back down into the actual order block with this down close candle, all right? So the moment price trades back above that down close candle, you can execute, all right? You don't even have to execute there. You could be, let's say because that down close candle is inside of the range of that OB, right? It's deeply inside of the range. You might even wait, right, and come here and execute. Biggest point is that you have an order block. All right, you can see price stays inside of the range of that down close candle. All right, but when it comes to Model X, all four steps are here. We have our sweep, we have EFD, order block is validated here. Price trades back down into the order block. All right, and then there's your second CSD. At that point, probably the third CSD. But you'd execute right here, right? No need for market structure, anything of that sort. And then we're coming literally right here at this point, and you can place stops below that low and potentially attack that high. All right, does that entry make sense?
Yeah, it makes sense. Thank you.
Perfect. There's another opportunity here. This is around like 2 p.m. you have a sweep, you have the imbalance. So sweep, imbalance is negated right here, order block is validated, and then price trades back down into the order block. Your entry is right here. Even in the stock market. Maybe you hold to the next day. I don't know. Not a stock guy. Cool. That was fun, I guess. All right, anyone else? All right. All right. Well, as mentioned, I'll have weekly outlook out to you guys this week. Let's come into the
Hey, Chris, somebody got a question about back testing that they asked in the chat.
okay. All right. What do we have? Let's check it out. How much data would you consider to be useful to give an accurate assessment of these stuff? I'd say challenge yourself, right? Go back to a time window where you have no collection of what occurred during that time. And maybe like a quarter worth of data, right? So I would go through a quarter worth of data on one asset, right? Just back testing that one asset. And it depends. Like, are you back testing the entry model? Or are you back testing an actual setup, an entire trading plan, or what? But whatever you're back testing, I say gather a quarter's worth of data, and assess it from that standpoint. All right, last call for questions, and then we're gonna wrap it up.
Any homework for this?
Yeah. So for homework, what you guys can do for homework is we'll keep it simple. Just go and find 10 bullish, perfect bullish examples, 10 perfect bearish examples. And what you need to do is you need to mark out the array, right? So make sure you make sense of the overall framework for that execution. So marking out the array is key, because obviously we don't use Model X until price reaches inside of some type of higher time frame array, and then we move into that response, which is Model X. So 10 bullish scenarios, 10 bearish scenarios. I want you guys to really outline every single step, 1, 2, 3, and 4. And then your execution, your stop placement, and let's see if we can make any adjustments or any offer any refinements. But that's the only way that you guys are going to get super familiar with seeing this stuff and comfortable with allowing it to actually play out and just waiting on that entire process. Because it will occur, like even right here, right? If you were trading, I don't per se look for Judas after 4 a.m. But if you were trading this and you saw that previous day's high was taken and you want to take shorts from that previous day's high, all right, I can see the entry model here on the 4-minute time frame. Let's go down to the 2-minute and see if it occurs also. All right, and what you'll do is you'll walk the time frames to see if to see what time frame is giving you the better image. But we take out the previous day's high. This would be EFD and OBV, literally right here. All right, and then we don't trade back up into that candle until we get up into this point. All right, and then price is coming back down, and you'd execute at this moment, right? The moment we trade down below that candle. It's a 3-minute chart, so you can take that execution immediately. All right, and up in here, everything is efficiently traded up in here, right? But where you place your stop is dependent on your own risk tolerance, right? And then price carries over. So it's the same process every single time, right? Nothing will ever change. But all right, that does it, guys. I'll see you in the chat throughout the week, and outlooks will be posted tonight. Thanks.